Every great investment you've ever made started with the right connections. Connections to the world's most sought-after investment community, dedicated to improving business and society. You are part of this community. Welcome to iConnections Global Alternatives Conference. In 8 short months, managers and allocators who control a combined $60 trillion in assets have used our platform. But as you know, there's more to our story. Funds for Food was the largest capital introduction conference of 2020, facilitating over 3,000 meetings with the industry's most sophisticated investors, while also raising nearly $2 million supporting those in need during the pandemic. We followed this with Fund Women Week, the largest capital introductions conference in 100 Women in Finance's history. Initiatives like these are at the heart of iConnections' mission. In early 2022, we will combine the latest in virtual and in-person participation at the world-famous Fontainebleau Hotel Miami. You are part of this community because you are the people with the vision to improve society. Invest in progress. Welcome to the world of iConnections.
Hello everyone, I'm Ron Biscardi, the CEO of iConnections. I'd like to thank all of you for participating in this year's Global Alternatives Conference. This is our first year hosting this event, and of course, it's virtual. But we are looking forward to our first in-person Global Alts event, which will be held at the Fontainebleau Hotel in Miami Beach during Hedge Fund Week in January 2022. This event will feature world-class content prepared by the iConnections Investment Institute, followed by 2 days of one-on-one capital introduction meetings, which we project will number over 10,000. This event will be free for allocators and open to managers who are members of the iConnections platform. So if you're not already a member, please go to iConnections.io to learn more. Thank you for joining us, and stay safe and healthy.
Hi everyone, my name is Mark McGoldrick, Director at Cowen Prime Services. Cowen offers a comprehensive global suite of prime brokerage and outsourced trading services that provide investment managers with customizable and scalable solutions. The firm was built by former investment managers with solutions designed to mitigate the operating responsibilities and allow clients to focus on their core competencies, investing. We're excited to be supporting the iConnections Global Alternative Conference, and events like these in combination with the iConnections platform are helping keep our industry connected at this difficult time, and we're proud to be part of it. And now it's time to get to the subject at hand. We're fortunate to be in the company of Mathieu Chabran of Tikehau Capital and Leslie Picker of CNBC. Mathieu Chabran is a financial entrepreneur and co-founder of Tikehau Capital. Since its launch in 2004, Tikehau has become a European pioneer in the industry, with over 25 billion of assets under management and more than 500 employees globally. Tikehau specializes in private debt, real estate, private equity, and capital market strategies, and has been listed on the Euronext Paris since March 2017. In his time with Tikehau, Mathieu has supported a number of philanthropic organizations, including Heart Surgery for Children of the World Association, the French Paralysis Association, the French Firefighters Mutual Fund, and Pupils et Orphans Fund, among others. Prior to Tikehau, he held roles in high-yield capital markets at Merrill Lynch and real estate debt at Deutsche Bank. Mathieu will be interviewed by CNBC's Leslie Picker. Leslie joined CNBC in February of 2017 as a reporter covering hedge funds, private equity, and asset management. During her career at CNBC, Leslie has interviewed prominent names, including Ken Griffin, David Einhorn, Leon Cooperman, and Bill Ackman. Her investigation into Puerto Rico's debt crisis won a Society for Advanced Business Editing and Writing Award and was the finalist for the Gerald Loeb Award in 2018. Prior to CNBC, Picker spent time as a reporter covering deals both on the New York Times and Bloomberg News, where she also contributed to Bloomberg Business Week, Bloomberg Television, and Bloomberg Radio. Please join me in welcoming Leslie and Mathieu. Enjoy.
All right, thank you, iConnections, for this chance to sit down with Mathieu, co-founder of Tikehau Capital. Thank you, Mathieu, for also taking the time. I just want to dig right on into your business and how you're seeing things. Before we do get to kind of the details of what's going on in the finance world, though, you made a pretty bold move this year in actually diverting your firm from Europe to the US and then seeking to grow it in the middle of a pandemic. Can you tell us a little bit about what that was like? What were some of the major hurdles that you had to overcome in doing so?
Well, thanks, Leslie, and hello, everyone. I would say that was probably contrarian. That's how I would define that. Effectively, when we decided a couple of years ago to move to New York and to add, some North American expertise and presence to the Tikehau platform, that was an obvious step. Obviously, what we've been experiencing, for the past few months now, is clearly a challenge, but in a good way. And I would say that all the people we are interacting with, be investors or partners here in North America, they definitely value the presence. And at this time where we have all this debate about not only the working from home, but can we effectively move away from the big centers, financial centers, be London, New York, Hong Kong, for other reasons. I remain convinced that being local, being present, having big boots on the ground, and being close to your partners, makes a difference. So yes, there's been a few headwinds, but I think we've all experienced that. But this is when you can gear up, and make a difference.
In terms of things like due diligence and hiring and deal making and getting to know the environment, I can't imagine what it's like to actually try and grow a business without being able to meet people in person. What were some of the ways that you actually got around that? And do you feel like you're able to do sufficient, research into the counterparties you're doing business with and the people that you're, would normally be shaking hands with, but, maybe doing like a virtual fist bump over Zoom? Is that enough to really supplant the traditional way of doing investing, especially for someone who is brand new to the area?
Yeah.
Not of investing, geographic area, I should say.
Yeah, no. I appreciate that. Well, listen, I think you're right. Part of the fun of the job is to have, dozens of lunch, dinners, with your potential investors or with the potential, management team of a company you'll be investing with. And clearly what we've been experiencing lately prevents that badly, right? But the good news, I would say, is if we go back a year ago, because effectively it's been a year, there was a massive shock in the first few months. Are all business going to a standstill? Will you be able to develop new relationship? To create a new partnership? And what we've experienced, and to your earlier point, being a newcomer here and having the bulk of our operations in Europe, is that we saw some large U.S. investors, public pension funds, their consultants, starting going online. And actually what should have been in normal way, what we called an on-site due diligence, you could not even fly out of JFK, right, to London or Paris. So, the on-site was becoming extremely remote. And we started seeing people doing the whole process over Zoom or over, remotely like this, 2-3 days sometimes of 10, 12 interviews a day with all the teams and completing that all the way to the investment, despite being a new relationship, Leslie, which is obviously the encouraging part, because as we have experienced and many of our peers, competitors have experienced, is we tend to do more business with people we knew in those circumstances, and cracking new relationship from an investor standpoint became obviously a little bit more challenging. Nonetheless, at least 9 months into this situation, we see that investors are adapting very well, and that's extremely encouraging. That's for the fundraising. On the investment side, likewise, it went extremely, it became very pragmatic, the way we've been doing that. Again, going back to my point, we are in a people business, and that's partly in the private market that we're operating with, and this face to face, but in 3 dimension and not 2 dimension, obviously something that we're missing. I just came back from Europe, and part of the European market was still open. I can think of Paris or Madrid, and you still have as we speak today, I've got some colleagues effectively with investors having lunch in Brussels, and you need to have this type of face-to-face contact. So as much as this situation, this remote situation has been helpful, I'm hopeful that it will not become the norm. Not because you cannot do business, but that is taking part some of the fun of our business.
How much of that do you think will return to normal, as they like to say? Do you think that we will be back to the days where we're dining out with breakfast, lunches, dinners, drinks, in the typical course of relationship building? Or do you think that there will be, as you pursue deals, some due diligence will be supplanted over the internet. Some of the negotiating will be done over Zoom, even after it's okay to shake people's hands and so forth. How do you see the future of deal making as we watch more people get vaccinated and kind of hope and pray for a return to some kind of normalcy?
Yeah, as we all do. I do believe that you will not take away, this relationship part, this human part. Now, some part of the excess of our business, where you jump on a plane for a couple of hours meeting, in Europe, on the West Coast, in Asia. I mean, all that I think is gone for a while. Let me tell you just a little story. Last year we were bidding. We were competing, for a mandate in Australia, from an investor in Australia. We were in Europe, not even in Paris, in Marseille. We were in an offsite with all our team, and we got selected. And they say you have to be in Sydney, the day after tomorrow for this beauty contest. We said, well, it would be a 2 hours meeting. Why don't we do a Zoom? And that was pre-COVID. And the answer was from the consultant running that anyone not attending in person, will not make it to the second round. And this type of, craziness where you effectively cross the world for a 2 hours meeting that you could do over Zoom, I think that has gone. That is gone. But back to your point about, creating relationship, socializing, in a very good way. I'm not only hopeful, but I'm convinced that this will come back because, again, we're in the people business, and that's human nature, to get together.
You're saying next year, everybody who's watching over Zoom right now is going to be in Miami, perhaps.
Here we go. I'm looking forward to that, Leslie.
Maybe even more, because people will be, there's such pent up demand to attend conferences and see people and be in warm weather, at least if you're in the north these days. On a more serious note, in addition to the pandemic, which we just discussed, there's been a health crisis. We've had an economic crisis. Perhaps we still do, depending on which part of the economy you're looking at. We've had a social justice crisis this year since you've moved to the US. Most recently, we were on the verge of what many consider to be a constitutional crisis. So clearly a multitude of these just catastrophic events that, for any decade would be, massive news. We had them all compressed in a matter of about a year. So what do you make of the political environment that you found yourself in? And does it alter the investing strategy at all? I mean, the markets, despite all of these various headlines that we're seeing, have just been basically ignoring them and moving upward.
Yeah. I mean, it's an interesting question. Many questions in this question. I mean, first of all, talking about the market, since we're focusing on the private market, and maybe we'll get back to that. We tend to be less focused on what's happening on this public market. Even if I have my view on the excess maybe that we are living through right now. But coming back to your question about all this perfect storm, if I may say, that we've been going through, what strikes me, Leslie, and being an entrepreneur, that's maybe my naive, positive outlook of the world, is that what does not kill you make you stronger. And what we've experienced here, as individuals, as corporation, as nation, as people, even I mean, kids, you look at the kids, if you're a 5 years old kids or a 15 years old teenager here, effectively that's an experience, right? Now, they putting that this way, some of our my partners were saying, that was not World War II. What we've experienced, is terrible, but look how functional, all that remains, and how positive, and all the positive we've been taking, out of that. Now, the density of effectively all these events, and leaving aside again the financial market and the investment strategies, effectively have been pretty intense. But think about where we were 15 years ago, or 14 years ago with the beginning of the GFC. We in Europe, after the Lehman Brothers 08 and 09, we had the sovereign crisis. 3-4 years after that, remember Mario Draghi, whatever it takes, and maybe 8 years before the US, we started using the monetary policy, as effectively a way to drive some stimulus plan, and all that was very intense. So what I actually think, Leslie, that it's a succession of experiences, and I don't want us to have short memories. I mean, we've been dealing through very as risk manager. I'm coming back to what we do for a living as a risk manager. We've been living over the past 20 years through some pretty intense and extraordinary circumstances. So here, back to your last part of your question, look at where the financial markets are today, where they were 12 months ago, and I think that today or yesterday was the first day where the first case of COVID was identified in the US. So it's effectively been 12 months. Part of the world, if not the whole world, has been shut down for 9 months or maybe 12. In some part, with very limited interaction, traveling, as we discussed, social interaction. And yet you've got this, you've got this very positive trend of profits, from companies. Companies and management teams have been extremely reactive in adapting their cost base. I mean, ironically, when you don't travel, the world, and you don't have to pay 2 hotel nights on the West Coast or Paris or London, and I don't know how many meals for a 2 hours meeting. Obviously, all that go to the bottom line, right? You had a little bit of that of financing costs that have been extremely constructive, lately. So, I would say, as much as you're right, there are some very worrying point in this whole situation, that I come out of that, and I don't know if we are 20% into this situation, or if we're getting close to the exit. But what struck me is how quickly companies, people, investors manage to adapt. We live that, in our own firm, at Tikehau, it's 600 people, 12 offices. We had to navigate the lockdown, sometimes, compulsory, other times, we decided to do that for the sake, of our teams. And, pretty young teams we have, and we see, how they manage to adapt and yet, deliver. Now, back to what we were saying, they are all eager to be back on the pitch. Here in New York, small operations, we've got 40 people, but we reopen on Labor Day. We've been having 80 to 90% of the team here. And as you know, New York today is probably not the most the funniest place, on earth, or in Americas, and yet people are looking for this, get together, for these small talks that you can get, and not only, well, sorry, I have to jump because my next Zoom is starting.
That's right. And I promise you, as in a way of welcoming you to the city, it does get better from here. Just wait till Broadway reopens and you can eat indoors. It does get better. Assuming there is still a restaurant industry at the end of all this, which I'm optimistic there will be. Given kind of the various dynamics, and you have such a global business, I'd love to hear your thoughts on where you actually see opportunity right now, which just kind of broadly from a more top-down perspective, given just all the change that's taken place, where are you seeing opportunities now that you may not have seen before? And where are places that were previously somewhere you sought opportunities, but now it's looking maybe a little expensive, or that it's kind of past its peak?
Yeah. Well, we could spend a long time on this question, but let's start, top down, as you said. So we're a private market specialist, meaning that, we're active in private debt, private real estate, private equity. We do some capital market strategies, but I would say that if you start with private credit, for example, a year ago, people were wondering, questioning whether there's been way too much dry powder in the private debt markets, if there was some kind of a bubble because too much money was chasing too little deals. And what we're seeing today post-COVID is that actually the asset manager, the credit asset manager, like us and others, are a very genuine alternative for funding sources to corporates alongside banks, because banks are back and it's a great news. The capital markets are wide open for the very reason we mentioned, but not everyone can issue a $200 million bond. Not everyone can have access to a 500 million, banking facility. So this part of the market post-COVID, and not in a distressed way, because people are like, oh, you guys are only, focusing on the bottom of the barrel that the banks or the capital market are not focusing on. That's not true. It's more, the flexibility, the nature of the relationship, and so that part of the market extremely attractive at a time where interest rates are low and for longer, I guess, both in Europe and in the US, and where institutional investors are looking for some yield. A derivative of that, and that's one thing we've been really focusing on, at Tikehau, is a secondary private debt, for the very reason I was mentioning earlier. So many people have been allocating capital to private credit over the past 5 years that some of them today, are looking for some liquidity to arbitrage their portfolio, to reposition their portfolio, and similar to what the secondary private equity business has enjoyed, 15 years ago, 10 years ago. We're seeing real opportunity on this secondary private credit, because liquidity remains the name of the game and what people are looking for. So that's one part of the market. On the private equity side, Leslie, and to your point about valuation, we've never been a controlled investor and an LBO player, and we're looking at that, scratching our heads when you see the type of multiple. So the feedback today is the good assets are trading for very expensive multiple. The average assets are trading for much lower, and the bad assets are not trading at all, which is a good thing. But when you look at the multiple that are being put on these companies, the free cash flow multiple you're seeing as a consequence of effectively the financing available here, I'm questioning a little bit. So that would take your question as to where do we worry? Now on the growth capital, on the growth equity part, which is what we're focusing on, meaning providing a flexible, long-term, patient capital to entrepreneurs. Family-owned businesses, like second, third generation family-owned businesses who are looking at taking advantage of the situation out there to consolidate the market. I'm a 50 million, 100 million EBITDA business, and I can buy my competitor operating, next door. The bank is willing to lend me, 50, but I need 20, of equity, and that's where we're going to be coming in. So in terms of sectors, where we are seeing the biggest opportunity is certainly on the energy transition, coming from Europe and maybe being a little bit early on this process relative to the US, but I really think that that's the next big opportunity here in the US. We see a lot of opportunity there. Yeah.
When you say energy transition, do you mean transition toward more sustainable energy sources, and how do you invest to capitalize on that?
Yeah, it's really about moving towards the low carbon energy, and that comes back. Yesterday the new administration signed up to the Paris Agreement. That we celebrated back in December, the 5th anniversary of this Paris Agreement. That has stated some very ambitious goals, and yet 5 years later, in 2020, we were the economy were the globe was emitting more green gas than we were doing 5 years ago. So despite all the ambition that had been set, we were clearly missing that. So not only we welcome seeing the US coming back here, but low carbon mobility, energy storage, let's say building efficiencies, on reducing the energy consumptions. All that are real focus that requires some capital. I mean, we know that if you look at all the studies, the scientists, in order to reduce by 1.5, 2 degrees Celsius, effectively the global warming, that would require roughly 7.5 trillion of investment. That is only a fraction of the 80 trillions of savings that asset managers are effectively managing. So if you can capture part of that, direct all these resources, not to do buyout, as we said, and buying from one to another and looking at multiple expansion or things like that, but effectively directing this capital, not only you're taking, that goes way beyond the ESG objective, is just doing good by allocating properly, the capital. So that's one part of the private equity that we're expecting, that we are really experiencing great opportunities and expecting it to grow as well.
I was going to ask you this later in our conversation, but you know what? We're going to take a pivot because you brought it up, this idea of ESG, which, environmental social governance, it's become a very, very, very hot topic in 2020 amid all those various crises that we talked about earlier. People are kind of paying new attention to this idea of investing for good, whatever that means to the individual investor. So on that front, what do you do on the private equity side as you kind of employ these ESG overlays? How do you screen for them? Because it's one thing to invest in a company that is liquid and you can sell out if they do something that you believe is meritless and therefore would be impactful to the stock. It's another thing if you buy a company that you intend to hold for a longer period of time. So how do you kind of view ESG? What do the LPs expect of you on that front?
Yeah. Well, you can approach this, 2 ways. One way, which is what I would call the traditional or historical way, was to say, in order to be sustainable, I had to be profitable, as if, that was coming in a second step. I think, the paradigm has totally reversed, and that's certainly, where we're coming from, in a way that today, in order to be profitable, you have to be sustainable. And so that's where the paradigm is totally shifting, because it no longer comes, in a second phase, but that's defining upfront. It's defining with your investors, people who are effectively giving you capital to deploy. It's defining with the companies, you finance. More importantly, Leslie, it's defining with your team and your people. More and more, I can see, we have fairly young population at Tikehau, 36, 37 years old average. I mean, the young, the graduate, joining us today, it's part of their DNA. It's not something that was artificially plugged on top of an investment committee. Oh, and by the way, did you check the ESG box? It's no longer that. It's effectively, it's by design, if I may say. And so this shift, and again, coming maybe from Europe, we were maybe a few years early relative to the US, but I've been here for a couple of years, and I've been really positively surprised and shocked in a good way how quickly these issues have caught up, in terms of focus. So that's really how I would put it. It's a shift in paradigm, and really putting that first, and more importantly, doing it. We're just we're wrapping up, our first private equity fund, focusing on the on this energy transition, that which will outpass, our initial objective target, and despite being a first-time fund and all that, and what we're seeing, out of the we deployed almost $500 million in mid-market European companies, really, profitable. They're very much, cash flow generating. That's 6 or 7 investment we've made. It's 3,500 jobs, Leslie, that are being deployed, by these companies. So at a time where you see people questioning, scratching their head, obviously, the airlines, the hotel industry, the leisure, the restaurant, that will, you've got all these, unfortunately, this segment of the industry suffering, but you've got all the part of the very traditional industry. I'm not talking tech here, I'm not in the green tech. I'm talking, really basic, in a good way, businesses like building energy efficiency. And what can be done out of that, again, for good, but also as an investor, making good return. Again, in order to be profitable now, you first have to be sustainable.
Fascinating. That I think is going to be an idea that really catches on, especially as we look forward in 2021, and it's something to definitely keep an eye on. I just wanted to pivot to some macro thoughts of yours. I figured we could maybe have a little fun with this, do it kind of rapid fire, where I will, because you have such a broad look at a variety of asset classes, private debt, as you mentioned, real assets, private equity, capital markets, just to kind of remind our viewers here. I figured we could talk about some subjects in the market and get your thoughts on kind of where they're at and what the future holds for them. Starting with rates, that of rates.
The rates, you mean interest rates?
Interest rates, exactly.
Yeah, no, I heard REITs, like real estate.
Oh, not real estate, no. Well, we'll get to that. Actually, that's on my list. We'll get to that in a little bit. But starting with rates, yes.
Again, coming from the other side of the pond, we've been living in this zero to negative interest rates environment for years. Mm-hmm. We know that there is this very strong central bank, willingness, to help effectively relaunch all that. It has worked, it helps, but it can be, I wouldn't say deadly, but not too far from deadly, from some investors, insurance companies, people who effectively cannot afford, years and years of negative interest rates environment. Here in the US, we saw that, they've been using, and rightly so, and, what we saw, last year in March, they've been using extremely, in a very voluntary, manner, these interest rates policy. But now what we are seeing is, given all the stimulus plan that we are seeing, all this money flowing into the economy, that you see that, slowly the interest rates now, is increasing, on the, on the back end. And that's always this very sensitive balance between, is it going to create some inflation at some point, or do we need this money, straight away? There is one comment that, to come back to the very first part of our discussion, is we should be extremely careful what those interest rates policy are driving, in terms of consequences, because this very cheap access to credit, be for nations or corporates or individuals, is actually creating a widening inequality between the people who can access to this very cheap credit, and in turn, it widens the gap, and the one who can't. And the one who effectively have, $10,000 of savings, with their insurance company, and instead of making 4%, now we're telling them, oh, you made only 1% that this year, but nothing I can do about that is the interest rate. So it's it's very it's a very subtle equilibrium. If you take the long-term history, we all know that that cannot be sustained, on the in the long term. So if I was to take a guess, 5 years out, interest rates are higher.
Only one way to go, basically. On that front, next topic is inflation. So reading between the tea leaves, you think that inflation will resurface?
Well, there are clearly, two types of inflation, right? Obviously, when 10 years ago we were paying, I don't know how much for so some technological things, and today, that's become extremely cheap. I mean, what we saw is that inflation is effectively moving. I mean, wage inflation is one thing that one has to keep an eye on. And right now, my concern is that again, looking at the European experience, is that all these monetary policy, all this liquidity flowing into the system is still stuck at the financial levels, meaning that creates inflationary pressure on financial asset prices, because it does not flow down into the, what I call the real economy, which, by the way, is probably driving back to your earlier point about the financial markets and the public markets valuation. And that's one area where, I think governments should be more focused. Again, as a private market investor and manager, it always strikes me, why am I lending to this company at 5, 6, 7%? Okay, as in our direct lending practice, when effectively you can see that double B companies, are issuing, at sub 2%. Well, again, it's not that it is a bad company; it's just that the market is segmented in such a way that the liquidity remains, stuck, on the 10th floor, when you would need more, on the first floor. And that's where, the structure of the market, it creates great opportunity for people like us. But we should be mindful and if not worry, mindful that this excess of liquidity does not only create inflation on financial assets prices.
And speaking of, just the future and the types of assets that, could benefit, what are your thoughts on infrastructure, especially as we have this new administration taking over and this idea that they will seek to potentially improve the infrastructure? Although I've heard this movie before. So do you think things will be different this time?
Yeah. Well, I don't vote in this country yet, so I will not comment or elaborate on your statement. But clearly, the infrastructure play, even more so in the US, seems to us extremely timely. I mean, as a matter of fact, at Tikehau, we acquired and we JV with a platform, Star America, last year, and they're focusing on mid-market infrastructure in the US for this very reason. I mean, we've been seeing all the infrastructure play in Europe. I mean, here in the US, effectively in some parts, it's lagging, and in combination with the new administration and the statement that have been made, and part that I think it's 130 or 150 billion of the 1.9 trillion plan that will be dedicated to infrastructure in step one. We know that PPPs will certainly be the way to best address those infrastructure requirements, because obviously it's costly, and being positioned, on the transportation, on energy, on social infrastructure. I mean, we believe that there is a real win-win play here, because it's needed and required by the community. Investors, love that, because it's long-term, long-dated, recurring income type of assets, and there is a real need in front of that. So that's one area where we're expecting to see a significant growth here, and not only for the GFK LaGuardia type of project, which are gigantic projects, but effectively mid-market regional needs and projects.
Excellent. What about equity valuations? What's your thought on those? Especially, I know you're not investing directly as much. You do have a capital market side of the business, but obviously it relates to flows and all the other various asset classes that you do spend more of your time in.
Yeah. My concern is that many of the flows going into the public equity, are being driven by default. And what I mean by that is someone reminded me this morning again that cash is trash. Okay, because if you have cash, and if you take the European example where banks are charging you for holding cash, you deposit 100, January 1st, at the end of December, you get less than 100. Then they move into credit, and credit, same thing, rates that we discussed. corporate bonds, high yield. When you look at what where the spreads are, on the high yield market, and so as you move up the risk spectrum, you end up into the equities again. I would say almost by default, where many of them, it's no longer about PE multiple, as we learned at school, but it's a turnover multiple. So, again, as I say, I'm not an expert. Some of my partners and colleagues are, but I'm just a little bit nervous, having seen, 98, having seen, 2001, 2009, that here again, I hope people don't have short memories, because such valuation, are based on growth assumption that in a broken global economy as we have today seems to be a little bit stretched.
Mm. Yeah, I hear you on the learning about valuations in school and then seeing something totally different take place in the market. I graduated from business school just 7 years ago, and I feel like I need to go back. But unfortunately, it was an expensive degree, so that won't be happening anytime soon. Commercial real estate. Last topic. I teased ahead that we would talk about real estate. I would like to focus on commercial in particular, because that aspect of the market has been just totally disintermediated, especially as it pertains to retail and the workplace, even office buildings and so forth. What are you seeing there? And do you think it'll come back?
Yeah. Well, massive structural changes, obviously. Now, I don't want to overreact to what we've been experiencing for the past 9 or 12 months. I don't buy the 100% work from home, as we said, and office space, will remain. What we are seeing now, again, in terms of valuation, let's start with valuation and cap rates, for the various markets. So obviously, real estate is a local place. You cannot take a general view. But what we are seeing right now, and what we've been very active in, is sell and lease back. So you're a corporate, you've got these real estate assets on your balance sheet that you've been carrying for years, and all of a sudden you're like, why am I using, why would I carry this real estate on balance sheet when effectively I could sell that to an investor and lease it back for 9, 12, 15 years. The investor is happy because he gets, his coupon and return. That frees up, some capital to me. So there's some kind of accounting arbitrage as well. But that's an area where we see a lot of opportunities, including, high-rated tenants. You can find some triple B, double A companies effectively doing this type of sell and lease back at a rate where, for the investor, it creates a real, I hate to say free lunch, but arbitrage where, adjusted from the credit for the credit risk, you effectively create a real liquidity premium. So that's very interesting in terms of investment. Now, specific market, here we're in New York, or look at London, where effectively you had so much supply being constructed, over the years. And here there is some, temporary shock to the demand that goes without saying. But what we are seeing, that people are shifting. Here in the U.S., people go from New York to Miami. They go to Austin, to Denver, to Nashville. And we see all these shift in demand that does not create. For me, it's not the end of the commercial real estate. There will be some adjustment, which are certainly welcome in some part of the market. There will be some cap rate arbitrage. But bottom line, we see this as a very interesting play. As a matter of fact, from an investor standpoint, both institutional and retail, we're seeing an increasing demand, because here again, if you can generate 4-5%, on some in euro, I'm talking in euro, Leslie, on some long-term leases, when the alternative for you is to get negative interest rates or 1%, you're seeing, this demand. And we're still, although, we've been more selective in 2020 in terms of deployment, you still see bucket of the market that provides for this arbitrage.
Great. Well, that is a helpful segue to what I believe will be the last question, since I think we are almost out of time, sadly. But since this is an allocator event, what can you say about portfolio composition right now? What strategies are gaining favor with LPs? Which ones are kind of slipping in priority in this current environment?
Well, definitely increased allocation to private markets, and that's not only in the U.S. You guys were very early in allocating more to private strategy, which was certainly not the case, in Europe. In Asia, it was a little bit mixed, with the Korean, obviously the Australian, the Japanese, pretty big there. But what we are seeing is that the structural tailwind that those private strategies are benefiting from as a consequence of everything we discussed earlier, is that we are seeing more allocation, meaning that it's no longer about grabbing market share from one manager to another to manage your ETF portfolio. It's really about allocating to a manager that will be able to source and originate the marginal supply to deploy this capital, and that's where platforms are key. And we think that global allocators, institutional investors, will be more and more selective, to those managers. So we're really seeing an increased allocation. And once you look at the private market, as you said, infrastructure is one of them. Real estate to a certain extent, for the reason that you get this long-term inflation hedged type of portfolio, which is another topic we discussed, and private credit, for the very reason that you need to generate and create additional liquidity for the mid-market companies who make up the bulk of the GDPs, globally. So that we're really convinced to see more tailwinds, to those strategies. And again, as a manager, we think that there will be more. You've seen all these, all these movements around what they call the alternative asset managers, because unfortunately, it's not just sitting in front of your screen and buying some QSIP securities when you do the job we do. It's about having, boots on the ground, having some origination capacity. And if on top of that, you can add, the alignment of interest and the skin in the game, normally you've got a winning combination.
Excellent. Well, Mathieu, this has been a wide-ranging, informative conversation. Thank you so much for sharing your insight and sharing your time. I personally enjoyed the conversation. I hope everyone listening did as well. So thank you for joining us.
Thank you, Leslie. Stay safe.
Thank you. You too.